And if you go back to, and I'm not saying that we're in 2008, but what happened was that when interest rates went up, the market went down, it then returned and rebounded. And then when there was an economic environment that was becoming particularly challenging, they quickly reduced interest rates, following which the market collapsed and then the return of investment opportunities came back. So one of the challenges that we have going into 2024 is, are we going to see the return of venture capital investment?
So here's a downward trend, right? And this downward trend is quarter on quarter. If you compare year on year, it feels like it's accelerating, right?
Have we reached the bottom? People are saying that in the US and Europe, the summer was the bottom and that we should begin to see an increase in risk appetite in venture. What the rate of return and what that slope of graph will look like, I think will still depend on the economic environment that we find ourselves in going into 2024.
I want to welcome you to the second season of Couchonomics with Arjun. Join us this season as we go beyond fintech and payments and embark on the journey into the future of financial services, a future which will be shaped by existing and new developments in technology and innovation, including and not limited to the likes of embedded finance, open banking, ESG, various versions of metaverse, decentralized finance, digital currencies, and other trends. On the couch, we're going to have the most influential and progressive-minded founders, executives, investors, regulators, innovators, and industry commentators from across the MENA region and beyond. Join us as we unravel a multitude of layers of the financial services industry and try to learn how technology will continue to impact the world that we live in. Couchonomics with Arjun is proud to collaborate with some of the most respected and innovative names in the world of payments, fintech, and technology. Arjun is a reliable end-to-end payment solution that provides innovation and flexibility to help businesses achieve their ambition faster by turning payments into a strategic growth driver. Get everything you need with 2U, a Saudi-based super app for delivery, mobility, on-demand services, and a lot more. 2U connects you to everything you need to enrich your daily lives by building an ecosystem across its end consumers, merchants, and reps. Visa is a world leader in digital payments, with a mission to connect the world through the most innovative, convenient, reliable, and secure payments network to enable individuals, businesses, and economies to thrive. GDA is a leading fintech and payment solution provider founded in Saudi Arabia, expanding rapidly across the region with established operations in UAE and Egypt. GDA's vision is to empower merchants with the tools to start, manage, and grow their business. M2P pioneers next-gen fintech through innovative offerings across payments, lending, and banking landscapes. Their comprehensive tech stack powers end-to-end banking services, BNPL, customized credit cards, prepaid cards, and more.
Welcome to today's episode of Couchonomics with Arjun. Welcome back. Today on the couch, joining me is Philip Bahoshy. Philip is the CEO and founder of MAGNiTT. And before I get into introducing Philip, I do want to say that actually I'm a big fan of the research which MAGNiTT sort of puts out there. And for those of you who I guess are foolish enough to follow me on LinkedIn, you'll always see that I will take their reports and share my sort of 2 cents worth on what my interpretation of that is. In any case, that's the plug I wanted to give MAGNiTT. But with that, Philip, welcome to the couch.
Thank you very much. Thank you for having me.
Pleasure. No, and I do mean it. I actually do thoroughly enjoy the reports that you publish, both the ones which are sort of free and paid for. This year, there have been 3 very interesting reports. Maybe there have been more that you've published, but there are 3 which I've sort of come across. There was, I think, one which looked at the first half in terms of what happened in the overall economy of the region, the VC and the PE space. Then I think you did a very interesting deep dive on KSA as such. I think there was a report which you did with SVC, Saudi Venture Capital, and then very recently you've published this report in terms of forecast of what the second half of 2023 would. So we're going to center around. We're going to talk about those a lot of my questions are going to be around those reports, but I am going to put you on the spot with regards to 2024 a little bit too, because I think we're getting closer to 2024 than 23. But before I start, right, from your perspective, now that, we're 8-9 months, actually we're sort of 9 months through the year, right? What's the kind of state of the region from an economic level before we actually sort of dive into the VC and PE segments?
Well, firstly, thank you very much for having me. And thank you for highlighting the reports. I think we've taken a different approach this year, and I think core to that has been trying to identify problems for which we're giving solutions to our clients. And why do I say that? Is because historically we may have been putting out just chart information, etc. And you asked me this question, and we did this in our client report for the first time in any communication that we were doing. We talked macro global, macro regional, then venture capital, because I think it's foolish not to put what's happening in the venture capital space in the context of what's happening globally.
I agree.
So when you characterize what's been happening, I don't claim to be an economist despite going to LSE, but I think that the things that are happening from a macro perspective globally are largely driven by inflation, rising interest rates, stock market volatility. In fact, in the H1 report, we said the background of venture is against a mixed macroeconomic climate. If you look at certain figures, interest rates getting almost close to 6% in the US to try and cool off inflation, and yet job markets remain robust. If you look at the stock market, last year in 2022, you saw a massive decline because of tech stock revaluation, and yet a rebound that has been extremely aggressive going into 2023. You look at regional kind of macro climates, strong continued growth in the UAE and Saudi Arabia, specifically in non-oil growth. Oil price volatility peaking last year, dropping this year, beginning to see a rebound. And yet, if you go outside of the GCC, you start seeing challenges in Egypt with regards to devaluation of currency, the impact of the war in Ukraine, which has clearly impacted the whole of the region in many different ways. Levant being somewhat challenged given the current economic environment. So really, not to say that it's a mixed bag of macroeconomic indicators before even diving into what's happening in the venture capital space. And I think that especially as we go into the Q3 report, that sentiment has continued and not much has really changed in terms of directional view of the macroeconomic environment, and not much has changed in terms of venture capital.
No, and I get that. And as a matter of fact, nor am I an economist. But I don't think it's an easy time to be an economist right now, especially if you've got to sort of, put your finger on something and say this is a trend. Yeah, fine. Over 5, 7, 10 years, you could still sort of start saying that, we are on an upward swing, at least with the UAE and Saudi Arabia. But, as you sort of distill it down to a quarter level, right, there have been lots of contradictory trends, if I may say so, right? And some of that are manifesting itself. Venture capital and private equity, to be honest, we saw the winter, as we call it, or as some of us call it, sort of come around in the global sentiment, global markets a little bit earlier than here. Yeah. But it has found a footing in this part of the world too, at least in my humble opinion, right? And I think that kind of leads me to I guess the second question, where the bulk of this our next 45 minutes is going to be spent, is let's start with venture capital, to an extent private equity investment in the region, some of the countries that you mentioned. But it'd be great if you could actually give me a perspective from sort of 3 different lenses, right? And I'll drop in a question if there is anything in the middle I want to ask. So there's a geographic lens, right, which is more at a country level, right? So how things have evolved from the start of the year till I guess now. The second lens would be very interesting, is the life stages in terms of a startup's journey, from very early stage to ones which are later stage growth or expansion stage. And then the third lens is from a sectorial perspective, right? Have you seen any interesting shift in terms of where venture capital is heading more or less towards? So keen to hear that view, and I think that should give us a foundation for the discussion.
I think the first point is to go even global. I mean, before we jump into the region, I made the point that in H1, I went to our key clients, whether they were governments, large corporates, ministers. For the first time, I did a roadshow and actually met with the key stakeholders, because what tends to happen is when numbers start collapsing after what has been effectively 5 years of record number, people then question the data and saying, oh, maybe the data's wrong. And it's not that the data's wrong. And the first thing that we did in the H1 report is take global publications for venture capital. And when you look at the global publications, the trend is very similar. In fact, the only stark difference is that the beginning of the decline of venture capital ended at the end of 2021, and the beginning of the decline in venture capital here in the region started in Q1, Q2 of 2022. So there is a almost 1.5 quarters delay in impact. You could put that down to reporting of data. You can put that down to investor behavior. You could talk about the largely driven by US being a lot more transactional and active. But effectively, I'm a big believer at this point from all the conversations that I'm having. With interest rates progressively going up to close to 6%, the crowding out effect, which is often talked about, whereby if you're a pension fund, if you're an investor, if you're a family office, or you're a private individual, can go to a bank and get a fixed deposit at around 5%, or a treasury or corporate bond at 6 to 7%. And with somehow miraculously the S&P being close to 16, 70% and the NASDAQ much higher, your returns for venture as an asset class have to be close to 25 to 30% compounded year on year for it to be interesting not to go to a safe haven. And that has definitely impacted the US market a little bit quicker than it has here. But of course, naturally, it follows suit. So the first thing I was saying when speaking to the ministers and kind of key clients is, number one, it all looks red. But number two, this is not out of line of what's happening globally. And then you start digging, as you mentioned, into the specific geographies. MAGNiTT covers Africa, the Middle East, Pakistan, Turkey, and now covers Southeast Asia. And you begin to see some divergences at a regional level, but effectively the trend remains pretty much the same. You can speak to, in this case, we'll talk about the Middle East. The big challenge that we've had to do is strip out what we call mega deals, or what all publications call mega deals. Mm-hmm. A mega deal is a $100 million plus investment. Anyone who was reading MAGNiTT 5 years ago, it was called Kareem and Souk, because they were the only two companies that would raise an investment round greater than 100 million. Now there are many more companies that do that. And when you remove the underlying impact of those mega deals, everything started declining for about 5 quarters. And the bottom of that trough started in Q2. We saw the lowest quarter of investment capital and transactions dating back to almost 2019. I'm coming into preparing for the Q3 reports, which will be published in 10 days. It's the second quarter that is the same amount of capital, but with 30% less deals than Q2. So looking at the actual trend, we're reaching a plateau. But most interestingly, both quarters didn't see a mega deal investment dating back to 2019. And when you look at the geographies here, we were talking about specific countries. Saudi Arabia saw a strong start to the year, and we'll come on to Saudi, but that was largely driven by 2 mega deals in Na'na and Flowered. And when you look at Egypt, Halan's one investment has accounted to close to 85% of all capital in Egypt. And when you remove that, it's a very dry couple of quarters, especially in Q3, in terms of invested capital. So even within the MENA region, you see different divergences of capital allocation.
No, I agree. And I don't want to build a bleaker picture, but and this is my view. And again, it doesn't need a comment from you. I sort of dig a little bit deeper in terms of the nature of investment. And what we've seen is a lot of money which has flown in the last sort of 18 months has been actually debt. Right, and a lot of that debt is debt to lend, right, which has been raised by 2 of the large BNPL players. And personally, I'd like to strip those out too, yep. Right, because I actually don't see that as capital going there to necessarily grow the working capital of a business. I agree, and that starts painting a bleak picture.
But just to to comment, we don't count that as part of this. We only look at the equity exchange. And so no grants, no exits, no IPOs, no debt. We have a separate venture debt report, which will be published later in the year, which will account for venture debt alone. But the numbers that I'm specifically speaking to include no venture debt.
Okay, so if I didn't take, okay, so you talked about you talked about mega deals, right? Now, there are two very interesting sort of dimensions which I want to dwell into. One is this, I guess there were a number of mega deals earlier in the year which have slowed down in the last 2 quarters, right? You also mentioned the fact that the number of deals are going down. Let's take the second one down. So I had a conversation with one of the leading sort of fund of funds in the region, right? You know the organization too, but no names to be taken here. And one thing which was quite startling, which was coming out from that discussion, was that the team I was speaking to was saying we're actually not seeing the deal flow.
Yeah.
Right? Is that something that you guys in your research picked up?
Look, it's very difficult because we don't look at the subjectivity of the deals. I can speak as Philip, who goes out to the ecosystem, and people have been complaining about the quality of deal flow for the last 5-6 years, but nobody was complaining when the record numbers of investments were being put into place. I think, again, if you look at interest rates being at 0% for several years leading up to the rise, people had to allocate money somewhere. And the FOMO that built into the venture capital space meant that many companies were being invested in. And again, I keep repeating this after almost 8 years of doing MAGNiTT, that venture is not a charity. It's an expected exponential growth in terms of return for investors, usually in a portfolio theory, either in venture as an asset class, i.e. you make 20 investments in the hope that 2 pay off, or as a portfolio theory for an endowment where venture is one asset class amongst equities, debt, real estate, and others. And therefore, it's still kind of a specific mandate for investment. And for the last couple of years, where it's been record years of growth, it has been growth at all costs. It has not been unit economic focused. It has not been a path to profitability. It has not been frugal mindsets. In fact, many founders have not had to experience that, and they had relied on the next round of funding in 12 to 18 months. When that stops, businesses can begin to get challenged. And so without knowing what the potential fund of fund was talking about good startups, how they classify good now versus what was good a year and a half ago may have completely changed. So not to say that they're incorrect, but I don't know that the fundamentals of the companies have necessarily changed. It's just that the economic environment that we're in is completely different.
So let me reclassify the deal flow. I'm not purely talking about the quality of the startups, right? And I totally agree with you. That's subjective. Investment philosophies have changed. Macroeconomics have changed, so on and so forth. I'm just talking in terms of pure number of startups out there seeking funds. Have you seen in your research, have you seen a genuine decline in terms of a number of new early stage startups coming around?
If you're talking at the very early stage, I mean, ultimately, as a founder and speaking to other founders, it's expensive, it's time consuming, it's difficult. So where things get challenging, it's not often that you jump ship and then start founding a company. Now, off the back of COVID, where many people were working from home, there was this explosion of people who had disposable income built up and wanted to try something different. So I can't specifically speak to the fact of the number of companies that are setting up, but in a high inflation environment where it's very costly in specific geographies here in the GCC to kind of be able to survive, it's not uncommon for you not to want to start building a company. But I can't speak to that specifically. Okay. In fact, if you flip it, what I would say, and we'll come on to late stage and the fall off of late stage investment, the one area that doesn't really reflect in the numbers because it's difficult to do so, that we have seen consistent investment is at seed and Series A. Valuations have come off almost 40% compared to last year. I would say that they're not new startups. They're probably startups that have been around for 12 months that have had to be much more frugal and unit economic minded. That means that they are a lot more interesting for investors, specifically where valuations may have come off. that the actual risk for investment at seed, given that it's a 7 to 8 year journey for a startup, is a lot less volatile than trying to bet big on a late stage investment. So I would say that the only segment that has continued to see investment, if not increase, is investments of about $0 to $5 million.
Right. And that's why, the likes of Flat Six Labs and others
Absolutely.
have actually had, I don't want to call it record years, but they've actually, they've made considerable number of
Exactly.
investments, both across UAE and KSA, and I'm sure that's the case in Egypt too. You just mentioned late stage drop off the cliff.
Yeah, well, again, we actually just recently published, and this week, a report on what was a client demand. Is there a drop-off of late-stage investment? And we looked to deep dive into the last 5 years of investment. So what's late stage? We categorized it as any round after Series A.
Okay.
And the reality is that there have not been that many. There have been quite a few in the last couple of years, but in the grand space of investments, there have been few and far between. And therefore, we saw 20% annual compounded growth in late stage funding. In fact, this year, I think 700 million came from late stage, Series B+. But 80% of that came from 3 mega deals. So highly concentrated late stage investment. The challenge that you see, going back to what I mentioned about interest rates, is people are a lot more sensitive when ticket sizes are 50, 60, 70 million to the potential return that will justify that in 2 to 3 years than at 1 to 5 million, which looks to pay off in 7 years. And what you've basically seen is a drop-off of international investors. In fact, I think we looked at the total amount of capital that came at late stage last year was 54%. That's dropped to about 13% this year. That drop off is very significant. Now, naturally, international investors, Sequoias, your big Tiger Globals, your SoftBanks, etc., in the venture market that we're currently in, will naturally look at their home markets. They'll look at their portfolios. They'll go closer to home. Where they had excess liquidity in 2001, 2000, potentially 22 early months, they were looking at opportunities in the region. And yet now it's completely dried up. And I'd love to tell you it's been filled by local investors, which is what the team was saying. Oh no, but we've seen more regional investors. The reality is the amount of capital has dropped, that the only people playing at late stage are regional investors. And we actually looked at the breakdown of who they are. The proportion that have come from venture capital has dropped as well. You're seeing a higher percentage coming from family offices, corporates, even private equity. I can speak to potential clients of MAGNiTT, the number of private equity companies that have become interested in understanding a specific question. How many companies at Series A or Series B that raised a round prior to, for the sake of argument, July 2021, haven't raised since that could be in line for a conversation? And that's how we've been engaging with clients to try and understand that. But the reality is that the valuations have gone down, the capital's gone down, and hence everything's kind of dropped in terms of the overarching numbers in the market.
Okay, we're gonna get into what happens next soon. But can I request you to sort of hone a little bit into the sectorial view? So can we talk a little bit about fintech itself?
Sure.
Right. So with everything you've said, right, what's kind of the state of the nation as far as fintech is concerned?
It's been fascinating for me. I mean, I've been doing MAGNiTT for 8 years and we've been looking at all the data. When I started, everything was about souk. It was all about e-commerce websites, e-commerce in Saudi, e-commerce here. Noon comes around, first unicorn startup without it ever existing, at $1 billion of investment. Then it moved into transport and logistics, and you saw the likes of Careem, Fetcher, many different platforms trying to compete in the effectively same logistics play. The first one was product, home delivery. Second one was people, trucker, the likes of that. The third wave that you see, and this is not uncommon, and I've done the research in other emerging markets. If you look at LATAM, if you look at Africa now, if you look at Singapore, when you look at Grab and the likes, the third wave comes in financial services. And as someone who worked in the financial services, both as a consultant and banking and in Barclays, you realize that in a region of 17 countries, different regulators, challenges with regards to remittance and transfer payments, somewhat antiquated banking services. It's ripe for disruption. But what people seem to misunderstand is it's not the crypto and the blockchain and the fancy things that get venture capital. It is the equivalent of your Kareem pick up and drop off, but for money. Payment gateways, payment platforms, remittance platforms, anything that solves the problem of transfer of funds. And the reality for the last 2 years is that at every report and every presentation that I did, fintech, fintech, fintech. And if you look at even in a down year, fintech investments by number of transactions was the equivalent as the next 4 industries combined. And the total amount of capital was almost double the next one, which was a mega deal e-commerce platform play. So I think that even in the challenging economic times where people may spend less on transport or spend less on produce, they still need to spend money. And it's also to a certain extent coming from a more nascent environment. You're seeing more consolidation in e-commerce. You're seeing consolidation in transport and logistics. The companies that are booming in financial services are still requiring funding. And I think that I was speaking to an investor yesterday, a mentor. The third wave of entrepreneurship and founders are really beginning to think globally, which hasn't necessarily been the case. The first wave looked at how to solve for a country. The second wave started to look at how can you become the dominant regional player. You are now beginning to see founders thinking, well, why can't I go global? Predominantly because actually being regional is more of a headache than trying to look to operate at a global level in specific geographies. And then in the financial services place, that is a play that can transcend global markets more so than potentially e-commerce and transport and logistics.
Interesting. So you know, I have a view. So I think I completely agree with you that I think we've seen I guess a proliferation in terms of fintech in the area of payments, or or what I may call sort of basic payment technology. You've seen obviously the emergence of a couple of large BNPL players, which is a 200-year-old concept refashioned for the digital age. Obviously, e-commerce enabled it. What for me has been lacking has been what I called the infrastructure play in fintech, right? And I think for that so-called antiquated banking system, or the fact that it still takes us 6 to 11% to remit money cross-border, and actually you could fly quicker from here to Japan with a bag full of cash than to transfer money. I think a lot of the I guess investment needs to go into infrastructure. I'm starting to see some good infrastructure fintechs come out, right? Yet to see any of them really sort of jump and establish themselves even at a regional level. I think there are a few candidates. Again, we don't want to necessarily get into the name, but I'm hoping, and this is just my wish, that a lot of these people start to solve for the problems which are regional and local before they sort of go global, because I do think global brings a dimensional challenge, at least in financial services, which is not yet solved for by anybody. Yeah. Right. As in how PayPal doesn't exist here in any sort of true sense. Square has not arrived here. Grab and Gojek are still in Southeast Asia, and even banks. Right. There are very few global universal banks. Citi was, I think, the last bastion, if I was to say, called, and they themselves have also sort of stepped away. So let's see how that sort of plays out. Right. In terms of the way the money has flown in fintech, right? Has there been any difference in terms of early stage versus sort of growth and expansion, or has it sort of followed a very similar curve to what the rest of the
ultimately
industries has?
It's a similar curve to other industries. You have not seen, as you highlighted, except for buy now, pay later, entities that have got to mega round of investments. And as you alluded to earlier, the venture debt side is an important element of the buy now, pay later and certain financial instruments. So from a pure venture capital investment perspective, you have not seen the big deals of what Kareem and Souk and those type of entities previously acquired, or your Kutopis. I mean, Tabby is one example, Tamara. But again, they're coupled with a buy now, pay later combination in that space. So they're more nascent, they're growing. There's a lot more early stage. There's plenty trying to do neobanking. There's many different type of platforms that are in that space. Just to the point that you were making, I think that the regulatory environment that some of these geographies are in, I've been speaking actually just this week to a few entities. The regulatory environment is extremely challenging. So a lot of the funding that they gets spent without having the product or actual revenue mechanisms, and the team needs to be able to solve for those challenges.
It could take as much as 2 years.
Without actually seeing any revenue generation. The second part is that it's beginning to get competitive in that space, which is no bad thing. It's always good to have competition. But cross-geographical barriers to that means that you need to replicate that in specific areas, which can get very complicated in the financial services. And the lack of clarity around that regulation can be an inhibitor to growth. But herein lies what basically many believe in the Middle East or any emerging market, where there's challenge, there's opportunities, and that's what they ultimately look to transcend. But to the question that you were saying, the majority has been, let's say, up to about 40 to 50 million in terms of venture capital, coupled with, in certain cases, venture debt that can support in that growth.
Okay, so great, and this sort of takes me into the second half of the discussion which we were talking about, which was around the late stage, where you've seen the international investors, for whatever reason, sort of pull out or pull back from this region. They've gone from 54%, as you said, to 13%, and I think that is of a smaller absolute value also. So in absolute terms, that's
for late stage specifically.
I'm talking specifically late stage, right? And then you said that some amount of that has been covered, obviously 87%, but again, in absolute terms, that's lesser by local, more regional investors. So let's talk about local and regional investors, not just late stage, just generally, right? And I genuinely want to be kind of educated on this, right? Because this is an area which interests me a lot. Now, first hypothesis, please bust if it's a myth, right? I don't necessarily see a shortage of dry powder. What I see is the shortage or the willingness to deploy that dry powder among maybe the LPs, right? And so correct me, this is just purely a hypothesis, right? As in I have conversations, I'm not looking at people's bank balances, right? So one is that, right? Second part of the question, I've got 3-4 parts, so let's stop at the second part and then we'll get into the third and fourth. The second part is that CVC, right, is as a concept, it's easy, you Google CVC, gives you an answer, but it's not a concept that the vast majority of the corporates have really got a handle on, right? Including the banks. So if you look at the Citibanks and the JP Morgans, they're incredibly active with their CVC arms, right? Tens of investments they have made in the space of fintechs. The comparables here, right? Again, there are no comparables in terms of size, but if you were to say relatively, they've hardly actually opened their checkbooks, at least from what I see, right? I come from a management consulting background, so we're also sort of chasing these opportunities. Please bust my myth on the first one, whether I'm correct or not. Secondly, what have you seen in the CVC space?
So remind me if I forget on the CVCs, because I think it's a very interesting subject. On the amount of dry powder that's available. Look, again, I've been doing this 8 years. I think that there's a lack of capital that's available at every stage. And that's just because there's a lot of hunger for investment capital. But before you get there, you need scale, you need a good founding team, you need unit economics, you need a problem for a solution. Break it down by stage. I think if you look at the UK as a model, you talk about that there's capital. Well, the reality is that in the UK, where there's an EIS or SCIS program, which are programs that are designed to allow an individual to get a tax break or a tax incentive to invest in a startup, where it is capital guaranteed to a certain extent by the government. I have many friends in banking consulting that are more than happy to invest in startups if they can get the benefit in exchange. If you look at the angel community that exists at very early stage here, you have no real visibility with regards to any benefit. The second is that the legal structuring of the region means that unless you go straight to an offshore entity investment, and many early stage companies don't necessarily go and invest in a BVI or AGGM straight off the bat, the legal implications of being a shareholder creates a lot of personal liability. And so how can you foster early stage investment is something that is extremely challenged. You also have the opportunity, why invest locally when I can just invest abroad? So that is something at the very early stage. You have the accelerator programs. You can argue that there is a growing return of investment from accelerator programs. But if you were to speak to me in 2020, we used to put a chart on MAGNiTT charting how many early stage startups received investment from accelerators versus seed stage funds, and it fell off a cliff because in COVID, lest we not forget, programs which are designed to foster community, mentorship, learning programs lose their value when you start doing it virtually. Mm-hmm. So they completely stopped in COVID. And I had a massive red flag to many of the clients that we have to say, look, accelerators have fallen off a cliff. Interesting now is the economic challenge that has presented itself, that there's an opportunity at early stage because many companies are starting up and looking for investment, and they're not coming from angels. So programs which are supported by government continue to see some growth. You then go to different stages of early, mid, late. The maturity of the market here has not necessarily got to the point where there are, I mean, you can speak to investors and they may challenge me on this, but stage specific. I mean, yes, there's early stage funds. There are some late stage funds. A lot of them had raised in the last couple of years and deployed. One challenge we have as a data platform is, what is dry powder? Is it the announcement that's made? Is that capital called? Is that tranched? Is that actually available for deployment? Only in the last 6 months, and in our report, we highlight publicly announced investment funds without naming any in particular, without necessarily knowing whether that is X amount in the bank or X amount to be raised or X amount to be given over a period of time. So I think the other part is how much of that is actually available for investment. And then when you go to late stage, which predominantly has been international, I've already mentioned that there's been a slight slowdown from that space. So not to demystify that there's capital available, I don't know whether the dry powder is actually deployable or hearsay. And again, you speak to people at the All In Pod who talk about the US. The reason that many of those GPs are coming here to the region is that the LP market in the US has pretty much dried up in this interest rate environment. People are saying, and I've had this comment many times, we've seen more international investors coming to the region than ever before. We've seen more investors deploying in the region. The first one I can agree with. If you read the FT, Bloomberg, Reuters, they're here, they're meeting all the sovereigns, they're going to conferences, they're having conversations. The second, the data doesn't necessarily reflect the fact. We talked about late stage. If you look at the total amount of capital, you've seen the lowest participation of international investors dating back to 2019, and only 10% of all capital this year has come from international investors. So I don't know that there is a lot of dry powder, which when you read headlines of big funds, 500 million, 500 billion or to be invested, like you really begin to question where is the capital. And I guess there is a role of sovereigns, which I think, I mean, conversations that I'm having now, specifically in Saudi, is beginning to kickstart the process. You are seeing that return. But the biggest challenge that you have had in the region is an exit question. Ultimately, return on investment. We did a quick survey at the beginning of the year of investments. I think we concluded that in the last 10 years, there's been 2,500 investments in the region on aggregate, which accounted for around 1,800 companies. Obviously, some do multiple rounds.
Yeah, sure.
How many exits there were was close to about 250. So less than 6% of companies that had actually raised funds had exited. And I'm not going to speak about whether they were good exits. They were just exits. And therefore that return back into the system, which is what many of the geographies that are in more mature markets see as the impetus to grow the ecosystem, hasn't happened. And we're now going into a cold winter, as you mentioned. That's not necessarily going to accelerate that return. So the need for sovereign support, the need for government support to re-kickstart or really support the local ecosystem as opposed to capital going elsewhere internationally is one that I kind of think that I don't know how much dry powder is actually available in the market. On the CVC side, We are seeing the emergence of more and more CVCs. We are seeing banks. We have clients of ours that are specifically focused in venture capital. We have seen the likes of Etisalat. You have seen STV in Saudi Arabia. There has been a growing momentum. Majid Al Futtaim has always been active in that space. Some have created venture arms. Some have created accelerator programs. Some are just making direct investments. And I think there is a role for CVCs, specifically because they're slightly more patient capital and can invest on balance sheet, as opposed to the kind of LPGP structure that you get for VCs that have mandates and vintages for which they need to deploy. So I think that there is a massive role of CVCs and massive opportunity rather than role for them to make acquisitions for that potential return, which you've already seen a few examples of, or direct investments in a market where valuations have come down close to 40-50% from what they were at the record highs of 2022.
So I'm going to ask a question, and I please feel free not to answer this question, right? And it's a question. So I'm very pleased to hear that there's more CVC action happening, or hopefully will happen. And I guess relatively, and I think the current valuations make it attractive. Things are not as inflated as they were 2 or 3 years ago. But the question, and again, as I said, Philip, please feel free not to answer. The $1 million or the $1 billion question out here is, how many of these corporates who are creating these venture arms, right, which are strategic in nature in terms of the way they deploy their capital, have the capability to ingest
companies,
these companies that they're investing into, and letting these companies either flourish as standalones or flourish as a part of some synergistic advantage? Obviously, there has to be synergistic advantage in the first one, but in the second scenario, they come into the fold. Do you think we have matured as a market?
Look, it's a great question. How can you characterize it? We have several CVCs that are clients of ours. And to a certain extent, it comes down to the talent that is managing the process. I alluded to earlier, there's different approaches by which a CVC can take to get into venture capital. You can acquire a company and see how it gets ingested. You can create a fund that is proprietary, that looks to invest in companies. You can create a venture capital arm of the CVC, or you can do accelerators and incubators. All of those different strategies requires a talent set that understands venture as an asset class. There has developed a more mature GP and associate level for venture capital. In the CVC, it comes down to incentives. When you're a GP in a fund, for the sake of argument, you can have carry and know that you're going to be in the long haul for deployment over a 4 or 5 year period, and that's going to be the amount that needs to be invested, and your return is on the exits. When you're in a corporate venture arm or corporate that looks to make venture investments, you may have 12-month incentives. And so when you talk about whether they can absorb the company, it's an alignment of incentives at a company level. It's an alignment of incentives at the individual level. And it's also an alignment of incentives for the companies that are being ingested into the entity itself. And so I can't speak to specific examples. Each different entity will have different approaches and strategies, but it is one that is needing some evolution of maturity, knowledge sharing, which is very different to an LPGP model of a venture capital fund. And so I think you've seen Majid Al Futtaim take several different approaches. Etisalat both makes investments at the company level and as the venture capital arm. You see other entities looking to kind of get into that space. I think time will tell as to how successful that process is.
All right, so one single answer question. Out of the 4 models you said, is there one which you see as an outright sort of popular one?
In the region, I can't speak to any yet.
Okay.
Ultimately, whatever is beneficial for the long term of the corporate is likely to be beneficial, and an alignment of incentives for each of the different parties involved. Where it's to experiment, that's a much longer term exercise. Where it's a direct acquisition, that's much shorter. An investment to acquisition, which is often the case in CVCs, takes a little bit longer, but you have to assume that there's an alignment and continuity of alignment, because of course corporates can change CEOs, can change management, can change corporate managers. Founders tend to stay unless they get replaced. So to answer your question in a long-winded way, I don't know which one is the best method. Time will tell.
No, I wasn't saying best. I was saying, is there one popular? Is there one? It's too early to say. You're saying. Yeah. Okay. So I want to shift focus to KSA, right? And get into and I really enjoyed reading your report on the KSA deep dive. Apologies if that's what it wasn't called, but I'm just calling it KSA problem. Deep dive. But before I actually frame that question, I think there's before I get into that, I want to ask a question in terms of this deployment of capital across the UAE and KSA. At least from the outside in, the perspective is that the vast majority of capital which is being deployed, either through an LPGP model or through a direct investment, tends to be sovereign or quasi-sovereign, right? If you move towards KSA, I think that becomes even more, I guess, prevalent, right? I'm assuming I'm correct in that hypothesis.
I had this conversation this week again,
right.
And there was a question to ask: how many investments in Saudi Arabia were driven by sovereign entities? Now, the reality is that the biggest catalyst in Saudi Arabia have come from sovereign fund of funds, but that has been deployed into funds, and those funds have then invested into startups. So is there a direct link? No. Is it to say that they're all sovereign? In the end, the beauty of the report with SVC, and I really credit a lot of that to Dr. Nabil's foresight, is that the transparency of information for what was an extremely non-existent or almost nascent venture capital has seen rapid growth. Now, of course, Vision 2030, the growth of the economy, one of those pillars, which really accelerated as a result of COVID, where the benefits of technology really helped catalyze the importance of startups and food delivery, healthcare delivery, all payment gateways, the removal of cash on demand, and that it was all paperless cash was all a result of COVID, has really moved towards a direction of focus on technology, diversification of economies from oil, employment, etc. I'm sure you can speak to Dr. Nabil and he'll say that his hope is that in 5 years' time, it will not have to be the focus of the government, and that the market had matured enough that the private sector, that the founders, that the interest from international investors going into Saudi Arabia means that the role of sovereign has already laid the foundations, and it becomes much more normalized in terms of an asset class. But at the beginning, the impetus is to kickstart what is a very nascent ecosystem. So from that perspective, there has been a concerted effort to focus on venture capital, which has been supported, but naturally, like any other geography, you can go to Europe, Paris, France, UK, many other geographies use fund of fund mechanisms to support the growth of the venture capital community.
No, I think you mentioned Dr. Koshak. I'm a big fan of his too. Every time I do get an opportunity, which isn't that often, to actually have a conversation with him. We were very fortunate. A couple of weeks ago, we were in a room with him talking about something which was related to what we are. I always leave the room having learned a few things that I wasn't aware of till before. So if I take KSA for you, so again, I'll take the sort of macro question from you. In 2022 to 2023, what shifts, what interesting sort of 3 or 4 trends have you seen in terms of venture capital and how that has evolved in KSA?
I think we go to the sovereign. There's government focus with multiple entities focus on entrepreneurship, whether it is MCIT, SVC, Jeddah Fund of Funds, even at Munsh'ad, the SME authority, you're seeing the creation of entities to help foster at each stage. They've recognized that there's a need for investment at early stage, whether it's the garage that was announced last week, yes, to provide an environment where people can come and set up at low cost, whether it's incubators and accelerator programs, and you have many, including Flat 6 Labs, 500 startups. You then go to the fund of fund deployments into local entities that are at seed stage and Series A. the attraction program of international funds to come and support and set up in Saudi Arabia for middle to late stage, and then the role of PIF in driving the likes of Sanabel, STV support at late stage investment. So I think that structure, if you were to put it on a whiteboard, they're really trying to fill each level of the life cycle, as you mentioned, of the venture capital space. The second is that you are seeing more and more talented founders starting companies. I think that entrepreneurship as an industry or as an employment is becoming a lot more normalized. I don't know if you've been to LEAP or you had the opportunity to go to the conferences. They're massive.
Yeah.
And the youth are embracing the idea that entrepreneurship, which in the Middle East has historically been family office, engineering, healthcare, work for the government, that it is a path to a profession. And therefore, the education and the intellectual capital transfer that happens for first-time founders is becoming stronger, albeit there continues to be room for growth. And ultimately, one of the biggest challenges of the region remains tech talent. We outsource a lot of our tech talent to other geographies. And therefore, government's focus on education at the tech level, both coming out of university and in deep tech, is one that is particularly apparent in that space. But what you're also seeing is with the unicorn program of wanting to have 30 unicorns before 2030, that the growth, one, needs to show and justify employment and talent acquisition. Two, that I also think that they realize that you cannot become a unicorn without looking to transcend geographies. You cannot be Saudi only. I'm sure you can, but it is easier to be scalable beyond borders, where some companies are acquiring, and we support actually some of those unicorn entities, identify companies in other geographies that they can scale into either through acquisition or inorganic growth, so that they get to a scale that goes beyond the geographical border of Saudi Arabia. So I guess those are some of the trends that we're beginning to see, because it's still relatively nascent. I'd love to tell you that there's an industry trend. I think it's the pre-fintech trend. It's still either fintech or e-commerce and logistics driven, the likes of Na'na, Flowered. I've seen others, Uniphonic. Of course, there's Tamara and other fintech players. So it's a little bit more level in an industry perspective than others which have seen an evolution in that space. But it characterizes some of the focus on entrepreneurship, which if you go back 5 years, wasn't really discussed.
No, I agree with you. And I'm sort of, for I guess my sense, I'm deeply embedded into the sort of the KSA, I guess, ecosystem. I spend 3 days a week in KSA every week. And I think a lot what you've said has resonated. But I'm going to put you on the spot with a couple of questions now.
Sure.
Right? It might not be anything to do with your research. So KSA is showing a lot of promising signs, right? If I was to take a sort of broad brush approach to it, right? Are you seeing early signs of the two following things? And again, you can sort of correct me, please, because these are hypotheses. One is investor interest is shifting out of some of the markets, including the UAE, and shifting towards KSA, right? Question number one. Second question number is that, do you anticipate a number of startups? And again, maybe I've got a fintech sort of bias to it, but I'll use the word startups, who might relocate their headquarters away from either Abu Dhabi or Dubai to the kingdom, right? To be able to avail of this, rather structured approach towards support through the life cycle. Your view on this?
Great questions, challenging questions. Look, let me put it like this. I went to Saudi Arabia for the first time, to Riyadh in 2008 when I was a consultant. What Riyadh is now and what it was back in 2008, even what it was 4 or 5 years ago, is a completely different environment.
I went in 2009, and so it's around the same time.
I went to LEAP this year, and for the first time took 4 of my team who had never been to Saudi Arabia, 2 who were ladies that joined me. And their feedback of what they saw in Riyadh was really mind-boggling. It was impressive. They were fascinated. They felt it was raw. It was different. They felt a buzz. So from that perspective, naturally, a lot is being done to attract people, regardless of capital, that there's an opportunity. Now, we can easily acknowledge based on fact, the population of the UAE, for a point of example, is 11 million. You look at Saudi Arabia, close to 35 million. So, it's different sizes of demographics. I think that people will need to be operating in both. And that's why I think it's not about necessarily shifting headquarter. One influence of the shift of headquarter is ultimately startups need to follow the cash. And it depends where they'll be able to raise funds. So if there is a focused effort for government to support local investment, part of that will be for needing to either relocate and or create a office in Saudi Arabia. So naturally, if you are looking to have a bigger addressable market, if you are looking for capital, if you are looking for opportunities in an environment where it is difficult to capture capital, I would not be surprised if not necessarily a full migration of headquarters or subsidiary offices being set up in Saudi Arabia to benefit from the two biggest hubs in the region. And specifically, the migration that we've seen has come from places like Egypt, where people have looked for capital, looked for a market that is somewhat less bureaucratic or challenge for them so that they can go and scale into that. I think the question of capital becomes a little bit more challenging. They continue to try and foster and encourage international entities. I think that the legal and the framework of legal entities is one that needs to be addressed both in the UAE and Saudi Arabia to get international investors more comfortable so that they're not just sending a rep to make investments that are done in BVI or elsewhere, but they're definitely courting the international interest. I went to Singapore in April as MAGNiTT looks to expand there. I had meetings with 10 investors, the top 10 most active, shall we say, investors in Singapore, 8 of which were coming to Saudi Arabia and the UAE to raise funds. And I anticipate that their eyes will be open to what is happening in the region. How that then translates into investment capital, time will tell. But even if they're intrigued and interested and meet founders and are encouraged by them, and I'm very high personally on the corridor of Southeast Asia and the Middle East, which I think is an untapped corridor in both directions. And several delegation trips have been done for Singaporean entities coming here, Singaporean delegations, South Korean delegations, Japanese delegations. There is a clear interest of Southeast Asia in the Middle East and Middle East in Southeast Asia. Again, geopolitics with the US and China go well above my head, but you can see that there's a natural opportunity that exists there. How that translates into capital in the kingdom, time will tell.
No, so you're so right, and I think you will hear in the coming months a couple of very interesting announcements. So actually, as a matter of fact, the firm I work for, one of my areas of interest, because I was fortunate enough to work in Southeast Asia for years. So, in my previous life, I actually ran a sort of a fintech, which had 4 markets in Southeast Asia and 4 in the Middle East. And that allowed me to get very close to some of the regulatory bodies down in Southeast Asia. And actually, you're going to see some of those come together. I do think that as a matter of fact, I always encourage a number of my clients to say, look more eastwards.
Absolutely.
Right? Look at India. Right? Look at what's happening in Southeast Asia. Even look at markets like Vietnam.
Yep.
Right, which are very, very interesting because got 100 million people, give or take, in Vietnam. So it's a young, sort of vibrant society. It's a society and economy which has kind of rebuilt itself on the back of war and all kinds of strife. So there's a lot to learn from the East. So I'm not saying don't look at the West, right? Yeah. But look at the East, and maybe East will give you some. So I think you're completely good, and congratulations.
And if I may, because I think I am high on Southeast Asia. Yeah. I think there's a huge opportunity, and I think that there is an educational exercise. I think my biggest takeaway from going there is that there is a misconception and or lack of transparency about what's happening here in Singapore, Indonesia, and the likes. And that's not ignorance, it's just they have not explored it in that way from a venture capital perspective. And similarly, there's been somewhat of a hesitation from entities here. Now, I'm not going to take full credit or any credit for it, but as we add Singapore, Indonesia, you have all of this data that's coming onto the platform in the next 2 to 3 months. When we release our annual report, you'll have benchmarks of economies, industries, and trends for what's happening in Southeast Asia and what's happening here.
Excellent.
And ultimately, I did a presentation for the entities in Singapore, and I'll be meeting some of the government officials in the next couple of weeks. We looked at GDP per capita versus investment capital, and you begin to see correlations. Obviously, Singapore and the UAE have many similarities and a lot of admiration about what's being done from a roots up perspective, the standard of living, the opportunities for employment, even the investment capital and the hub for that. You then go and look at Indonesia, Saudi Arabia, Turkey, size of population, GDP per capita, obviously differences, oil production. I think that there are opportunities for a corridor of Saudi, UAE headquartered, Saudi headquartered combination, collaborating into Indonesia with a Singaporean head office. And of course, India is in the middle. So sometimes India is almost too big and people are scared of entering.
It is.
But that corridor,
is scary, right?
That corridor, if you went back 2-3 years and it was like you needed to go to Kuwait and Oman and the GCC and the Levant and etc., you could now look at, why don't look those geographies and see how you break the barriers.
Africa is a very interesting area,
Africa as well.
which could be tackled jointly. I was early in the year. One of the things I'm very sort of very proud of is that I actually serve as an ambassador with the Singapore Fintech Festival. With that, the association with Elevandi, which is a spin-off out of the Monetary Authority of Singapore, on the content side, right? So I tend to travel every time they have an event, whether it's in Switzerland and so on and so forth. And we were in Kigali,
exactly,
right? And you know, it was great to see the level of Southeast Asian representation.
Yes.
In Africa, right? And for next year's event, I know for a fact that I think we're going to have a bigger Middle East presence, right? Yes. It's something that, you know, I myself am sort of working with the guys with Elevandi to make sure that, you know, next year's event in Africa, there are 2 which are being planned, are sort of well represented. I'm assuming you will be at the Singapore FinTech Festival. I'm hoping
potentially.
Okay, all right, but you're actually going to be pleasantly surprised with the level of Middle Eastern representation you will see this year. As a matter of fact, without taking any names, one of the catalyzing bodies of one of the countries we've mentioned is the platinum sponsor at the event. They're taking a massive delegation with them. There are a number of closed door events which are happening around it. So you know, we are starting to see that stuff happening. So that's very, very positive. Let's talk a little bit about, I'm conscious of time, I've kept you here for a long time.
My pleasure.
There was a report which you published looking at H2 2023.
Yeah.
And very interestingly, you gave sort of 6, if I'm not wrong, there were 6 different projections, right? Apologies, I don't remember all 6, right?
I'm not sure I can recount each one.
But I am going to put you on the spot. Now that we've come through a few of those months, obviously this was published a couple of months ago, right? I don't know the exact date, but it was obviously in H2. What scenario are we most likely to see out of those 6 play out?
Look, it's a great question. And this was, again, one of the key focuses of what we're trying to do with MAGNiTT. It came out of a client meeting with a ministry who are trying to understand, well, we had predicted that venture capital is going to be X by end of year. Are we right or wrong? And I said, well, we'll answer the question for you and we'll give you the tools to be able to do it based on whatever you like. So you can literally go on MAGNiTT. There's a seasonality tool. You can play around with an advanced analytics. And so we wanted to take somewhat of an academic approach that could identify where will we end up. And the 6 scenarios ranged from doubling the first year. Some of them are just crude, doubling how much investment came at the beginning of the year. The second one was to take COVID. I see a lot of similar trends in the evolution of the year as COVID, where when the impact of COVID hit at the beginning of the year, Q2 remained somewhat robust. Q3 fell off a cliff. Q4 saw the beginning of a recovery. The other ones, we've taken a global trend approach and then map that to what the MENA landscape is. And so each of these approaches was trying to give a logic as to where we will end the year. The reality is every one of them will see that investment will be lower than the total amount of capital that was deployed last year. In fact, I think the range is between 50 to a 70% drop on last year's figures. And as of coming here, we've gone above the lowest worst case scenario. We are close to the COVID scenario. And assuming that we get to a stronger Q4, which in my opinion can't be worse than what Q2 and Q3 were, albeit we've seen every year, this was born out of a seasonality analysis, that every year for the last 5 years, there's been a 35% drop in funding in Q3, driven by the summer effect. But this year, Ramadan and Eid both were in Q2. So it was an 80% drop in Q2. A further, I think it was a little bit higher net, it's pretty much the same. I think it's 5% or 3% higher in Q3. But historically, you'd see a rebound of about 45% in Q4. So we anticipate that there will be, with conference season, we've got GITEX and FII and things that's happening. I wouldn't be surprised if there's some activity. But in the spectrum of the almost 50 to 70%, I think we'll still end up just below the 50% at around 60% drop year on year.
Okay, so again, nor am I'm not a statistician, nor am I a research expert, but I look at these graphs, and sometimes I look at so many of them in a day that
Sorry. I just wanted to caveat an important point on that before we go into the details. This is excluding mega deals. Okay. And I think that's an important point to make. This analysis was excluding mega deals because it just takes one of those big deals to come out that the numbers kind of go wonky. So the analysis was done excluding the mega deals.
No, so I get that. And so thank you for clarifying that. And I think it is the right way to do it because as you said, in a market which is not as big in absolute numbers, a single deal worth $150 million and the whole market is different. So you need to kind of pull them out. So, thanks for doing that. And as a matter of fact, I think it's important for the wider audience who doesn't understand the nuances that these anomalies should be taken out. And that's why I kind of made the whole debt point because, again, I'm not pointing fingers at some of the other peers of yours who do reporting and they tend to put debt into it. And I usually sort of get onto my sort of favorite soapbox and sort of say, guys, take the debt out. This is not even working capital debt. Yeah. This is debt to lend. In any case, the point I was trying to make, right? So I'm not a statistician, nor am I a research expert. I look at enough graphs. So here's a downward trend, right? And this downward trend is quarter on quarter if you compare year on year. And in adding a little bit more dramatics to it, it feels like it's accelerating, right? I sit back and I get really worried about 2024. Yeah. Right. It starts painting a very bleak picture to, if I may say, novices like me, right? Or people who don't know the inside track, right? Has your research already started looking at 2024? Would it be out of place for me to put you on the spot and ask what you're seeing?
Honestly, I mean, it's not out of place. I'd be happy to tell you we haven't actually looked at it specifically, but one chart, and follow me on LinkedIn if you'd like to see it, because I've been fascinated with infographics. We want to chart the interest rate trend versus global versus MENA. We already alluded to earlier in the podcast that there is a slight delay in what happens in the MENA region. So obviously tracking what's happening globally will give us a slight indication. You only need to listen to the recent All In podcast that we're talking about the return of IPOs in the US and that you're beginning to see a pickup in M&A, which means that there is the potential of increased liquidity, that once VCs are seeing money come back, can they deploy a bit more? But the reality is that the other chart that I looked at on a personal level is when interest rates remain high, that yes, you see a return in the stock markets, but once the economic environment gets too challenging, the US, and we're talking about the Fed rate, will begin to very quickly reduce interest rates to stimulate the economy. And if you go back to, and I'm not saying that we're in 2008, but what happened was that when interest rates went up, the market went down, it then returned and rebounded. And then when there was an economic environment that was becoming particularly challenging, they quickly reduced interest rates, following which the market collapsed and then the return of investment opportunities came back. So one of the challenges that we have going into 2024 is, are we going to see the return of venture capital investment? And you're right, there is beginning to be a how much lower can valuations go at seed stage? Are government stimulus going to be supporting the interest in this space? Is the travel of international ambassadors back to the region going to catalyze some investment activity? Or Other camps will say until you begin to see a decline in interest rates, so that the crowding out effect and the opportunity cost and the IRR calculations that you look at become more favorable for investment, that we won't see the accelerated return of venture capital. So to your basic point, have we reached the bottom? People are saying that in the US and Europe, the summer was the bottom, and that we should begin to see an increase in risk appetite in venture. What the rate of return and what that slope of graph will look like, I think will still depend on the economic environment that we find ourselves in going into 2024.
Right. So I guess in my simple terms, the advice to any founder is stay hunkered down.
Yeah.
Focus on extending your runway. If you need to do a down round, do a down round, because I do know quite a lot of founders in this region who have sort of avoided a down round for a number of reasons, right? Which I can understand, right? And then there's this whole concept of, in certain sectors, at least the way I see it, is that we have one too many players serving a need which is not big enough.
Correct.
And maybe there is some sensible consolidation before you run out of steam entirely and you have to shut your business. I wrote a very interesting piece back in March, which I reposted about a week ago, where I talked about co-opetition, where I said, for a number of early stage startups, if you have something unique to offer and you guys can complement with each other, this is not a bad time for you guys to start considering that consolidation play.
Yeah.
Because, if you run out of runway, you run out of runway, and then that's not great news. So,
But that's difficult because there are multiple players at hand, and this is another conversation that we were having, right?
Yeah.
It's a demand and supply. You need a buyer, you need a seller that's willing to sell. And the bit that sometimes people forget, and you mentioned down rounds, is that you got the investors.
exactly.
And they might not want that
And
exit.
that has been one of the biggest reasons why the down rounds haven't happened, right? And I've seen that a lot of people have actually raised smaller bridge rounds from the existing investors because they don't want to accept the down round, so they've raised at the same valuation.
Correct.
Or an unannounced valuation or non-unannounced value. I do agree, it's not just down to it. I do think that I think investors are getting a little bit more open-minded because, money diminishing at that rate is also not a great idea for them, right? Especially if the idea is good enough,
Yep.
right? And that's my biggest fear, is that in this sort of winter, the collateral damage might take some very good ideas and good founders out of running for not entirely their fault, right?
Yep.
And again, I'm being a little bit sort of being a bit of a romantic out here. So if I just sum it up, and correct me if my summary, you're saying we don't know if we've seen the bottom yet in the MENA region, right? We have not seen any green shoots yet.
Not yet.
Not yet.
I think that we are reaching the bottom.
Right.
How long the bottom is to be seen. Q4 will paint a somewhat interesting picture, but let's be clear, historically Q3 has always been bad. So if you balance it out, you'll see what that looks like. I think that the real sentiment test will come in the beginning of next year.
And then the question is, if there is a turn back, how accelerated that is going to be driven by a number of factors, including global sentiment, return of the investors, government catalysts, or government playing the role of a catalyst, and so on.
And I do point to the point that I said earlier. If there is a stage that will see investment capital, it will be at seed, it will be early stage, not so much at late stage. But even if you have hundreds of deals at $1 million, you're not going to see the amount of capital that you would have seen in previous years. So I think it's a dynamic shift. You might see increasing transactions of lower value, but for the return of that upswing, we need to see the bigger rounds come back to play.
Coming through. Yeah, and I agree with you. And I actually personally, I do think that at least that part of the statement is healthy, because I do need the front end of the deal flow. I think we need more and more out there, right?
Yeah.
Because, I give a number, Saudi Arabia wants to have, 530 30 odd fintechs operating by the year 2030 as a part of their vision, right? If let's assume a certain percentage of that comes through overseas players coming and setting up shop, you still need a very large percentage of numbers who are local, right? Currently, they have about 140 odd, out of which there are some international, some locals. If you're going to add another 400 in the next 6 years, you can imagine how many more ideas need to be incubated very, very rapidly, and obviously those things will need all kinds of help, including capital. So I'm actually quite happy that this might actually focus a little bit of the attention in the deal flow in the early stages, but I do understand for the numbers to return, you'll need those growth capitals and so on and so forth. Philip, I've kept you longer than
My pleasure.
I promised you. This has actually been educational for me, and I don't say that often.
Thank you.
But no, it's always good, right? Because you guys talk from the back of numbers, and I think that's the beauty of a conversation which is backed by numbers. We can always have conjecture, and we can go out and have a cup of coffee and dream about what the future would look like, and that's also very fascinating. But I'm very confident that people who have listened in will take some. We'll take a lot of value out of this conversation. So thank you for coming in.
Thank you. I appreciate it. I mean, ultimately, that's what we're looking to do, is kind of empower decision-making through data. And it's what the platform core is. And I always say I'm not a VC. I haven't got an agenda. I'm not a government. I'm not trying to push an agenda from that perspective. I am a founder, so I can speak to the challenges of being a founder. But I also look at the macro trends and really kind of try and benchmark and learn of what's happening internationally to see how decision makers, whether they are government, corporate, investors, founders, whoever it is, can better position themselves in the years to come.
Yeah, no, and I will continue to read your reports and,
Thank you.
and add my 2 cents worth wherever I have something to add. So everybody, that was Philip Bahoshy. He's the founder and CEO of MAGNiTT. If you've not heard of MAGNiTT, it is MAGNITT. So you can Google it or Bing it, whatever your favorite sort of search engine is. They do all kinds of reports, and I would recommend for anybody who's in, I guess, any industry, right? Because they cover all sectors, to actually, I guess, download the reports and read it. I just think it makes for a better understanding of the entire sector. With that, goodbye, and I'll see you next week. Thank you.